Continue with our discussion on Applied Corporate Finance Unit 2, and we were discussing on the hurdle rates and the capital asset pricing model CAPM. We have already covered the first part of that, which is the risk-free rate. Now we are supposed to find out what is the beta at some point of time, but in this particular video, we're going to look at what is the equity risk premium. Right, so we're going to look at what is going to be the risk premium that someone would demand for investing in a stock market over and above the risk-free rate. So RM minus RF is what is called as the equity risk premium. This entire term is called as the equity risk premium, where RM is nothing but the return of the market or expected return of the market, of the equity market, right? Remember, that's the equity market, and RF is the risk-free rate. So let's understand this in a little bit more detail as to what is this. This equity risk premium is the amount of extra return. Remember, extra return, and that's why we use the term RM minus RF over and above the risk-free rate that you would expect for investing in equities. As a general principle, it has to be greater than zero, because if you're getting 5% in risk-free rate, there is no reason for you to get lesser than that in equities, right? Remember, equities are riskier, and it's a non-zero amount of risk that you will take while investing in equities. Risk-free rate is essentially the debt rate, and given that equity is riskier as compared to the debt, you would want it to be a premium to be greater than zero. Also, it should increase with the risk aversion of the investors in the market. So if in general people are a little bit more risk averse for whatever reason, they don't like the stock markets, or they're just worried about what's going to happen in the stocks in the near term, in those contexts, the risk aversion increases. Risk aversion is going to create less likelihood in people taking those risks. Once that happens, essentially it is important that that equity risk premiums also increase, or the return that people demand. So the return demanded for taking that risk in equities goes up when risk aversion increases, right? So for taking the same amount of risk, I will want a bigger return, and hence equity risk premiums can go up. Now, one thing we need to remember is that equity risk premiums could be dynamic, and they could change from day to day. It gets proven by the fact that if the stock market has just fallen 20%, and then you ask someone, what is the excess return that you would want for investing in equity markets, this number would be higher than if the number was asked when the markets were stable. So if you ask in stable markets, what is going to be the equity risk premium, and someone says, I want a 5% extra return for investing in equities, in volatile markets, this number is going to increase. This number is almost always going to be greater than 5%. So risk premiums could change, and in a way they are reflective of what is the current market condition. Are they stable or are they volatile, right? So these two go hand in hand, and in extremely volatile market conditions, it is logical to expect that risk premiums would go up, right? Now, how do you calculate risk premiums? There are three broad methods of calculating. The first one is you can use a survey. So that's called the survey method. The second one is you can calculate historical excess return. Remember, the equation is RM minus RF. So you could find out what is the RM or return on the market in the last many years, and subtract the historical risk-free rate average from that, generated by stock markets over and above the risk-free rate, and assume that investors would continue to expect the same premium over the future as well. That's an assumption. Remember, what we are calculating is historical, so it's backward looking, and what we are assuming that investors will continue to expect it in the future as well, right? They are okay with the same return in the future as well. The third way, which is the most dynamic way, is that you assume that the current market level is correct, which means the market is sort of fairly valued, and you back calculate the implied return based on the current cash flows that you expect from the markets as a whole. So we will look at this in more detail, but effectively you assume with the starting point as the current market value, and